Good morning, everybody. Thank you for your patience. We wanted to make sure enough people were signed on before we get started. Let's start with introductions. My name is Maura Prendeville. I'm a Supervising Compliance Officer here at OLSE.
Good morning, everyone. I'm Bianca Polovina. I'm a Compliance Officer here at the Office of Labor Standards Enforcement. Welcome.
Thank you, Bianca. Let's start with a caveat here. I want everybody to understand that this presentation is very, very technical. This is aimed at large employers or insurance brokers who are already familiar with the HCSO and are reviewing their 2025 expenditures to see if it matches up with the HCSO's requirements. So if you're here because you're looking for a general HCSO compliance overview, this is not the right place. We're going to be doing a deep dive into a specific type of health plan called a self-funded health plan. If you don't know what a self-funded health plan is, or if you don't know whether or not your company has one, this is probably not the right place for you. Because we are only going to be looking at 2025 health plan analyses for 2025 costs. We're not going to be discussing 2026 compliance at all. And let me talk a little bit about the agenda for today. So my colleague Bianca is going to be talking about the HCSO background, the rules regarding self-funded plans, and how to calculate expenditures. Then we will talk about how to calculate and make top-off payments for in 2026. And we will also go over best practices at the end. And now we'll review a few housekeeping items. So first, this webinar is going to be recorded. All the materials will be posted on our website by the end of today. We will do a Q&A session after part 1 regarding how to calculate the value of health plans, and then we will do a Q&A session after part 2, which is how to make top-off payments. We will most likely not get to everybody's questions during the webinar, so if you have a question, please go ahead and submit it, and we will do our best to respond to it within 48 hours. Any additional questions either during the webinar or afterwards can go to our email address, which is highlighted here below, hcso@sfgov.org. And we do, our WebEx system has had some updates, so you may notice a different format than we've had in the past. To ask questions through the Q&A, you should see 3 little dots on the lower right-hand corner of your screen. You want to select the option that says apps, and there is now an app in WebEx called Slido with the green logo. That is how you can access the Q&A feature. Again, this is new. It is our first time using this, so if there are technical issues, please be assured that we will be able to answer your questions through our regular email channel as well. And now I will pass it off to Bianca.
All right, thank you, Maura. Again, my name is Bianca Polovina, and I work here at the Office of Labor Standards Enforcement. I'm going to first walk you through a little bit of a background on our office and on the Healthcare Security Ordinance. So once again, this is the Office of Labor Standards Enforcement. We enforce many San Francisco labor laws. Some of them apply citywide. Some of them apply specifically to city contractors, lessees, and grantees. Here at OLSE, we have investigative authority and enforcement power, and we also are tasked with offering technical assistance to employers, which is part of why we do these webinars very regularly. Our main website is sf.gov/OLSE. We pretty much have a special website and a special technical hotline and email address for every single law that we enforce. Everything from minimum wage and paid sick leave to the Healthcare Security Ordinance and many, many other ordinances. And what we generally just want to express here before we get into the very particular world of self-funded plans under the Healthcare Security Ordinance is simply to express to all of you it's much better for an employer or broker or anybody who advises employers and brokers to proactively reach out to the Office of Labor Standards Enforcement with any questions you might have. You will not be penalized for calling. If there is a compliance issue, it is way better to come to us proactively. We will help you fix it and get through it together. We also just want to make sure that everybody's aware that the City and County of San Francisco does pass new laws or sometimes amends our current laws on a regular basis. So make sure that you stay up to date with anything that might impact your business or the clients that you advise. And so, Maura, I think what I'm going to have to do is cue you for the next slide because I don't seem to have the power to cycle through the slide deck. So let's go ahead and go
Sure.
to the next slide, please. And we're going to move on to a little bit of background on this law, the Healthcare Security Ordinance. It's been around almost a couple decades at this point, and generally speaking, the Healthcare Security Ordinance requires employers to spend money on healthcare services for covered employees at a very specific rate. What we really want everyone to keep in mind here is that the Healthcare Security Ordinance is a spending requirement, not necessarily an insurance offering requirement. That is definitely the most common way to comply, and that is why we are here, because all of you either are working for employers or advising employers that have self-funded plans. So we're trying to figure out today, how do we figure out if those self-funded plans meet the spending requirements of the Healthcare Security Ordinance? So a lot of what Maura and I are going to talk you through today is pretty much figuring out what is your hourly expenditure rate for specific self-funded plans. So we're always going to kind of be coming back to this concept of what is the hourly healthcare expenditure rate. In 2025, the large employer expenditure rate was $3.85 per hour for every hour payable here in San Francisco. Um, there is a different rate for medium businesses. Medium businesses are between 20 and 99 people performing work for compensation anywhere in the world for the employer. But generally speaking, what we have found is it is the large employers that are offering self-funded plans. That's the reason that we're all here today for the next hour. So we're going to primarily focus on the large employer rate. So with that, keep in mind too that cued you on the last slide that every single year there's usually some exciting thing that happens, new labor laws or amendments to labor laws or reinterpretations of labor laws. So back in 2017, the Healthcare Security Ordinance went through something called a rulemaking process, and we had to do that in part because of all of this excitement around self-funded plans. So basically what that means is now what we look at when we try to figure out did self-funded plans satisfy the healthcare spending requirement under this law, we are taking an annual rather than a quarterly approach to figuring this out. So that said, anytime you want to read the rules on your own for your own edification, you can do that at our special website. The hyperlink is here in the slide deck. And then just to repeat for everybody, the slide deck, a recording of this presentation, as long as Maura and I make a good recording for you all, and all of the supporting documents will be posted to our website after the presentation. So let's go ahead and go to the next slide to wrap up the background before we get into some of the self-funded plan particulars. So remember that all of the other provisions of the Healthcare Security Ordinance still apply. Quarterly spending deadlines are still going to apply to those covered employees who are either one, enrolled in fully funded health plans, two, choose not to enroll in your company's insurance, or 3, are not eligible for your company's insurance. So this webinar is for the specific group of people who are covered by this law and are enrolled in at least one self-funded plan. Those are the only group of employees for which an annual assessment is appropriate. For everybody else, the employer still must abide by quarterly spending deadlines. So with that, we're going to get more into the rules of how to assess things for these specific employees. We're going to cover 3 basic rules.
Oops.
No worries.
Sorry.
Laura's just going to bring us back to the slide deck momentarily. There we go. Okay, I see it now. All right, so the 3 basic rules for assessing self-funded insurance under the HCSO. Number 1, the HCSO requires employers to look at money actually spent. Starting in 2018, employers can no longer use the COBRA rate to calculate a plan's value. That is because a COBRA rate is just an estimated value of a plan rather than a reflection of actual costs. So again, we're looking at actual dollars spent for rule number 1. For rule number 2, for the types of the self-funded plans where the employer pays claims as they incurred on a rolling basis, that's why we're all here today, the employer may calculate the healthcare expenditures on an annual basis. And again, for a fully funded plan, that doesn't happen. It's a quarterly basis. But for these self-funded plans where you are paying the claims as they are incurred, we are now doing an annual assessment. And then number 3, for those plans where you can do the annual calculation, if the employer's annual spend represented a shortfall in whatever way, the employer can make a top-off payment and must, in fact, make a top-off payment for those employees by the end of the month of February the following year. This particular year, the last day of February falls on a weekend, and so we are using Monday, March 2nd as the 2026 deadline. So again, keep these rules in mind. They're really going to guide us through a lot of what we are looking at, which the main goal is to get to an hourly expenditure rate for every single one of our plans. So let's dive right in and get to it. We'll go ahead to the next slide. Now we're going to start talking about how to do calculations for self-funded plans. So in the rules that we referenced earlier, there is a special rule just for this purpose. It is Rule 5.9. And what that says is, this is pretty much most of what we're going to be talking about today. Sometimes there are some other unique scenarios with these plans, and we'll address them. When employers pay claims as they are incurred, the employer may look at the annual spend for that particular plan. And once again, for employees enrolled in the fully funded insurance plan who are not enrolled in these self-funded plans, the quarterly deadline still applies. So now we're going to look at how the employer actually assesses the cost of the plan, which is all the money finally out of the employer's pocket. So we have already, based on our old HCSO days, we have this concept about a uniform health plan, and those are addressed in Rule 5.8 and in our frequently asked questions. Employers are permitted to average expenditures for the employees who are actually enrolled in the uniform plan and not for anybody else. So we know that for large employers, they typically offer a menu of different plan offerings, and each menu item has a different cost. So what we're really looking at is, when we say uniform health plan, we pretty much mean uniform benefit design. So with that, looking at this more specifically, we're going to give you an example of this. So what the employer must do is assess each plan individually. You cannot combine everything, your entire menu. You have to compare each line item only as to itself. So that means looking at your specific plans specifically. If you've got Kaiser HMO Silver, Aetna HDHP, you've got a PPO plan or two, you need to assess each of those plans separately. And we're actually going to walk you through that process. And what you might wind up learning as a result of this process is that some of your plans are going to immediately be in compliance, and then some of them might not be. So let's go ahead and take a look at what that looks like. So basically what we're trying to get to, our overall goal is we're trying to get to the total employer spend for that plan. And so what we want to immediately set forth for all of you is number one, the premium contributions from the employees will never enter this calculation at all. You are only looking at the plan costs, claims, and other expenditures, and then you are subtracting any employee share of cost for the employees enrolled in that plan to get to your total employer spend from that plan. So again, we're trying to get to employer costs. Let's take a look going a little bit further to the next slide to talk about what employer costs look like. You are going to be counting the claims actually paid in the prior calendar year. Here, that is 2025. You are not looking at only the claims incurred. You are looking at the claims paid. And the good news for you is that claims paid for any dependents enrolled in that plan, if you paid for them as the employer, you get to take credit for that. And just keep in mind, if employees pay a portion of premiums, you must subtract those dollar amounts from the claim. And again, we're looking at actual money paid from January 1 to December 31 of 2025, not the claims incurred. So let's break down some of these concepts a little bit further and see how it is that we define what is a claim. Claim includes, of course, all amounts paid directly to medical providers. A claim includes all tax-deductible medical expenses under IRS Publication 502, Section 213, and medical care services or goods having substantially the same purpose or effects. We do have some backup here with our rules, Rule 5.11, and in our administrative guidance, Section E. I want to talk a little bit about fees before we move on. Some fees, if they are reasonably related to actually paying claims, can be included as expenditures. Stop loss insurance is one such reasonable fee that may be included as your total claims. Other fees cannot be included. If you are paying consulting fees or fees associated with compliance with other laws like the Affordable Care Act, those do not count. The cost of, say, mailing those 1099Cs out to the 1098Cs, excuse me, out to the employees, those do not count. It's a little bit nuanced, and so what we want to just highlight here is if you have specific questions about whether or not a fee that you are paying can be included in these claims process, please reach out to us after the webinar. And just as another reminder, this entire presentation, the slide deck, recording, and everything else will be posted to our website after this webinar. So now that we know what a claim is, let's start talking about other ways that employers can and should be taking credit for their spending under this law. We want to talk a little bit about health savings accounts. Health savings accounts, generally speaking, Your contributions as the employer to an employee health savings account can be included. The employee contributions to their own HSAs can never be included, but all of the employer contributions can be. So we're going to give you a couple of examples. If an employer generally says, okay, as an offering of this plan, you enroll in this HDHP health plan, and we're going to pay in $1,500 per year into your HSA. That is an irrevocable healthcare expenditure. And as the employer, you get to take credit for all of the contributions. So we gave you an example here, $1,500 per year per employee. 400 employees are enrolled. You get to take credit for all $600,000 of that for the employees that are enrolled in those plans. Another possibility is some employers do this on a monthly basis. We have another example here of $75 per month in HSA contributions. We have done the math for you here. You also get to take credit for that. And just as a reminder, the contributions you can take credit for are the ones you actually make as the employer. Let's talk about another example, going to the next slide, about fertility services. So this is something that we see a lot, so we decided that we're going to add it into this presentation. Here's the example. The employer's self-funded plan offers up to $10,000 per year in fertility expenses. Now, we gave an example of fertility services, but this could really be about anything. It could be about mental health services or a variety of other options that you're offering, so long as they're basically defined by federal law as some kind of medical expense. So you've got 100 employees enrolled in that fertility services plan, and the employer allocates $1 million to this particular menu option here, fertility services. So in 2025, we'll say that 20 of your employees utilized these services. 5 of them went all the way, maxed out at 10,000, and 15 of them used $2,000. So what we are just wanting to really emphasize here is when you have some sort of optional menu item, don't count what you allocated for it. Count instead what you actually spent on that plan. So again, just keep in mind, look, coming back to this theme over and over again, this is about dollars actually spent, not allocated only. And speaking of dollars actually spent, we'll go to the next slide and we'll talk a little bit about something that we see quite often. This is why a lot of employers choose to use self-funded plans. Sometimes you get a refund, and you get a refund for a quote unquote good claims year. That's great, wonderful, so long as you understand that the amount refunded may not be included in the expenditure calculation. It is not money spent if you wind up getting it back. So here's how we recommend handling this. Because all expenditures need to be made irrevocably under the HCSO, you get a refund. That is not an irrevocable healthcare expenditure. The timing we recognize can sometimes be a little bit tricky, and so here is what we are recommending. If the employer receives a refund, or at least knows what the refund amount is going to be prior to the end of February, take it into account when you are doing your total calculations for the prior calendar year and subtract the amount of the refund from the employer cost. On the other hand, sometimes life does not work that way, and you might get your refund or a confirmation of your refund amount after you have already gone through all of this process. And we recognize that is not necessarily ideal, but it does happen. What you might need to do is you might need to repeat this process to an extent and do a second round of top off payments later in the following calendar year. And what I would generally say on refunds, especially, because they can be rather fact intensive and specific, do not hesitate to reach out to our office with your more specific questions about refunds. We are going to talk about top-offs later in this presentation. So again, we want to make sure that we are all clear on the time frame here. To be compliant, the employer needs to demonstrate that the preceding year's average hourly expenditures meet or exceed that year's expenditure rate. So the way that we have interpreted this is a self-funded plan will comply with the HCSO in situations where the employer pays claims as they are incurred and that calendar year's expenditures meet or exceed that calendar year's expenditure rate. What does that mean? In early 2026, when the employer assesses the cost of its 2025 plan, it needs to ensure that the 2025 plan satisfied the 2025 rates, which in 2025, the large employer expenditure rate was $3.85 per hour. So now we're going to do the fun part. We're actually going to collectively do some math together, and it is going to be awesome. So as we talked about earlier, what Maura and I are really here to do is help you understand what is the hourly expenditure rate for any specific plan. We need to have your total employer cost for that plan, and then we need to find out what are your total hours payable for employees enrolled in that plan. Once we have these two numbers, we can do the math and we can come up with an average hourly expenditure rate for that plan. We will break this down with many examples going forward. Just some caveats, refunds are not going to be part of this. Hopefully you will get them that information ahead of time and be able to deduct them from your total employer costs. And just remember, you're going to be doing this for each self-funded plan that you offer. It's not going to be one giant soup of all of your self-funded plans, but rather each self-funded plan specifically. So let's go to even more fun stuff. We're going to talk you through how to actually do this. So we have three possible ways for each employer to decide, based on information you have access to, how to average total costs and total hours payable for three different options. A, this is the most frequently used, is all employees enrolled in the plan nationwide when you know what hours they're working. Option B is all covered employees, meaning San Francisco only, in the plan. And then option C, which is probably the least employer friendly, but this is sort of the break glass in case of emergency. We don't have the right information. This is expenditures for all employees in that plan nationwide, and it rests on an assumption that everybody worked the maximum number of hours payable per month, or 172 hours per month. That 172 hours per month is pretty much a full-time employee, and it is written into the text of the law itself. For some of you, this is not a big deal because you have only a full-time workforce. For others, that might not necessarily be so appealing. Whenever possible, it is probably best to use either option A or option B. Option C is going to be sort of like your fail safe. You can't do anything else, so you've got to do option C. And just on a math note, 172 hours per month times 12 months out of the year, that gets you to 2,064 hours payable per year. So let's start walking through some of these examples. So we're going to now do an example of option A. And again, just want to stress, we're going to have some time for questions here today, as well as afterward. We will get to all of your questions, and by either the end of this webinar or hopefully the end of this week, you are going to know what examples best match your particular company. Option A, this is the nationwide average. This is when you know what your total costs are and what your total hours payable are. So for your nationwide average, Acme Corporation has 350 employees enrolled in this plan. 300 are full-time and 50 are part-time, working 20 hours a week. We are going to assume that you already have the total cost paid by the employer at $2,350,000 and that you've subtracted any refunds and you have not included any employee contributions to their premiums. So you've got the costs, you need the total payable hours. So you have 300 full-time employees. We're going to take 300 times 2,064 hours payable, which is all of their hours payable for the whole year, and 50 part-time employees at 20 hours a week. We're going to take pretty much half of 2,064, and we come up with a total of 670,800 hours. We simply divide total costs by the hours payable, and we come up with an average hourly expenditure rate of $3.50 an hour for that particular self-funded plan. We know in 2025, the hourly expenditure rate for large employers was $3.85 per hour. So we have a shortfall of 35 cents per hour payable here. And then Maura is going to kind of walk us through the top of options later. Before we do that, though, let's move through the rest of these examples. Option B is when you know and can isolate who specifically is working in San Francisco. This might appeal to some of you who have a predominantly Bay Area or California workforce. This might not work very well for those of you who have a workforce that's spread out throughout the United States. So we have Acme Corporation decides we're going to go for option B, and we know that we have 25 employees who are enrolled in this particular self-funded plan. They're all full-time, which is really easy, and we paid out $185,000 in those claims. We did not count the employee's share of the premium. We already accounted for any refunds. We have the costs. We need to get the hours payable. We have 25 full-time employees, 25 times that annual maximum of 2,064 yields 51,600 hours payable. We divide total costs by the total payable hours, 185,000 divided by 51,600 hours, and we get $3.58 per hour. This is still a shortfall, a smaller one, but it is 27 cents per hour payable owed to every worker in the top-off payment. Before we move on, we want to talk at least about going to the next slide, example C. This is much harder to wrangle, but this is sort of, okay, you don't know what else to do. You can't match up the nationwide hours with the nationwide enrollment info. You can't isolate San Francisco claims. This is sort of the only option. You've got 950 employees enrolled nationwide in this self-funded plan. You have no idea what their hours actually are, who's in San Francisco, who's not. So you have to assume that they are all full-time, and you have to look at everything. You have to look at all of the employees enrolled during the calendar year, regardless of how long they were employed. Again, this is not very employer friendly, but this is sort of the last thing you can actually do. So we've got almost $6.5 million in claims paid. We have 950 employees. We're going to assume that they all worked full amount of hours payable through the entire year. We have to use 2,064 hours as a stand-in because you don't know the actual payable hours for the enrollees. And we come up with almost 2 million hours payable. So we divide total cost paid by hours payable, and we come up with $3.30 per hour. So you can kind of see how this is not in the employer's favor per se, but it is still a close approximation. So we know that $3.30 per hour is short of what was needed, $3.85 per hour. We have a shortfall of 55 cents per hours payable. So let's go to the next step in accounting for other healthcare expenditures. We are going to kind of speed through this a little bit because I hear from employers all the time. Dental and vision, maybe you have self-funded plans for that, but not really a huge employer spend. You can still do this, but just keep in mind that when you are assessing your plans individually, you must also assess your employees individually. Anna, for example, is only enrolled in the medical plan, so Anna will earn the full shortfall. Beth happens to take the medical and the dental plan, where the employer is going to get a little bit of credit for that dental spend. Beth's shortfall is going to be less than Anna's. Carlos took it all. He took the dental, he took the vision, and as a result of this, for Carlos, there is no additional funds owed because the employer gets to take credit for medical, for dental, and for vision. So this is sort of like any other irrevocable healthcare expenditures that you might get. This is where you would account for them when you are doing a per employee analysis. So now that we have talked through calculating the value of the plans, I think going to the next slide, we want to check in and see if we are going to answer any questions live, Maura, or if we are going to go forward into the rest of how to do the top-offs.
Yes. Thank you, Bianca. We did get a number of questions that came in several times, so I'd like to cover those. One question is if we offer both self-funded and fully funded plans, how do we calculate that?
Great, very good question. Self-funded plans must be calculated separately from the fully funded plans. So you are going to be calculating each plan. Say you have a fully funded HMO plan and two self-funded PPO plans. Your fully funded HMO plan, you're going to calculate that separately. You have a quarterly spending deadline for the people that are only in that fully funded HMO plan. For your two separate PPO plans, you're going to do all the stuff that we just talked about for each of those PPO plans. So again, just stressing fully funded plans need to be assessed on the quarterly analysis and spending deadlines. It is only the self-funded plans that go through this annual look back and top off process that we're talking about today.
Thanks, Bianca. Another one that came up a couple of times. Um, some employers said, I thought that because we have self-funded plans, we did annual top-offs for everybody. And are you now telling us that we need to should have been making quarterly payments for folks who were in fully funded plans or folks who waived the insurance? And if we haven't been doing that, how do we fix that?
Thanks for the question. Another thing that commonly comes from employers, especially when they attend these webinars, for the folks that are enrolled in the self-funded plans, go ahead and do everything we are teaching you and reviewing in this webinar. For people who are not enrolled at all, or were only enrolled in fully funded plans, yes, you do have a compliance problem, but you have resources. You have us. And so we would ask that you contact us individually after this webinar so that we can get some more specifics from you and that we can walk you through individually what you need to do.
Great, thank you. And then last question, we've gotten various iterations of this one, but how do we handle it if either our medical is self-funded and our dental and vision are not, or only our dental and vision are self-funded and our medical plan is fully funded? How do we address that?
Yeah, this is also a very common question. So what our law says and how we interpret it and how we enforce it and how we guide employers through it is if any employee is enrolled in any self-funded plan, you can do this annual process of assessing your spend. It gets a little bit hard if employees don't know if they're enrolled in a fully funded or self-funded plan. And generally speaking, that's not really something that is top of mind. So some employers do choose to do things differently. They still choose to do quarterly payouts, assessing the spend on a quarterly basis. even if someone is, say, enrolled in a self-funded vision plan. We can definitely give you more specifics based on that. It is a common situation. I would say, anecdotally speaking, any employees that contact us, sometimes this is one of the things that they have no idea about. So, number one, make sure whatever it is that you're doing, your employees know what you are doing to increase transparency. And then number two, for some of these hybrid or blend options, please reach out to us afterward if there is something particularly unique about your circumstances.
Thank you, Bianca. I think that was that was all the questions that came up repeatedly so far.
Okay, great. And then I think Maura will be walking us through some of the top off work.
Yes, thank
Thank
you.
you.
Bear with me while I make sure my screen is. All right, there we go. All right, so now that we have talked to you about how to calculate the value of your plans, we'll talk about top-offs next. So if you determine that your plan or plans fell short of the $385 per hour that was required in 2025, you'll need to make top-off payments by the end of February. As Bianca mentioned previously, this year, February 28th is on a weekend, so the deadline is the following business day. And so who do you make top-off payments to? You're only going to be looking at the San Francisco employees because this is a San Francisco specific ordinance. So even if you're using a nationwide average to calculate the value of the plan, you are not making top-off payments to everybody in the nation that's enrolled in that plan. You would only be looking at the San Francisco employees because those are the only ones that are entitled to top-off payments. And you will need to make the payments on a pro rata basis, so based off of the employee's payable hours, that's San Francisco hours, during the calendar year. So a full-time employee is going to get a larger top off than a part-time employee. And an employee who separated on July 1st is only going to get a top off payment reflective of that first half of the year, whereas someone who was employed the entire year will get a full top off. And former employees, if you had someone that left during 2025, they are still going to get a top off even if they're not employed by you any longer, but the top off can be calculated to account for their separation date. And now here's an example of how to make a top off. So we'll go back to Acme Corp. They have determined that there was a shortfall. So they've done their uniform calculations. They've determined that their nationwide average expenditure fell short of the HCSO rate. So they've determined that they've got a 38 cents an hour shortfall that they need to address. Now, this company, it's even though they're looking at the nationwide costs, they're only needing to make top-off payments for those 15 employees in San Francisco, 10 of which are part-time, 10 of which are full-time, 5 of which are part-time. So what does that look like? So after drilling down on the nationwide costs, they're now going to drill down on the top-offs owed to only these 15 employees. So they're going to take the hourly shortfall amount times the hours worked for each of those employees, and that's going to be the top-off amount. So you'll see the part-time employees here are getting much less than the full-time employees because they didn't work as many hours. And again, this was an example from earlier, but you can certainly account for any other expenditures made on an employee's behalf. So here, if the employer is looking at those 15 employees, they might see that they've got different enrollment options. So again, we've got Anna who's enrolled only in the medical. So her shortfall is going to be much larger than Beth and Carlos. If Beth is enrolled in the self-funded medical and also enrolled in dental, then her costs are higher and her shortfall is smaller. However, in this example, Beth works part-time, so the reduced number of hours that she worked in 2025 is going to impact her shortfall amount. So she's only owed a smaller amount because she's part-time. And then we've got Carlos, who was enrolled in everything, medical, dental, and vision, and was a full-time employee. In this example, because of the value of each of those three benefits, they don't owe anything to Carlos because they met the spending requirements because of his multiple enrollments. So once you've calculated how much you need to make in top-off payments, uh, what do you do with that money? So the most common way is by making deposits to the SF City Option Program. What your employee gets from that is an individual medical reimbursement account that they can use for any out-of-pocket expenses that they want to reimburse themselves for. You can also make deposits into an employee's health savings account if that's allowable under the plan that you have. You cannot make any sort of direct cash payments to employees, but if you have another way that you can make an irrevocable healthcare expenditure on their behalf, that would also be acceptable. So again, the most common way that employers will make the top-off payments is through the SF City Option Program, but a lot of employers are using that for their top-off payments in February and also are using it for their ongoing regular quarterly obligations. So there's not necessarily a way to distinguish between the two. So you want to make sure that internally you know which payments were made for annual top-offs and then which ones are made for 2026 compliance. So if you've got a simple notation in your records, that would suffice. All right, and so as Bianca mentioned, if there's a refund, that is not money spent by an employer. So if you're getting money back, you haven't actually spent it. So how do you address that with top-offs? So in our previous example, the employer realized it had a 38-cent shortfall and it made its top-offs. But then what happens if later in the year it gets a refund from its carrier? So in this situation, after the top-off payments had already been made, they get a refund. What they're going to have to do is recalculate the plan with backing out that dollar amount of the refund. And then they will need to make a second top-off payment. So basically here in this example in February, they made those top-offs to 8 to 15 different employees. And then in June, they reran the numbers. They backed out that amount that they got refunded, and their shortfall was larger than they had initially anticipated. What they're going to do is make those extra top-off payments within 30 days of getting confirmation of the dollar amount of the refund. So in June, they make an additional top-off to those same employees. And now here's another example, again with employees that have multiple enrollments. So here, if we look at Anna, who's only enrolled in the medical previously, so in February they had calculated the plan at $3.47 per hour, but later in May they are now realizing that the plan was actually valued at $3.24 an hour once they accounted for the refund. So they have to rerun the numbers and they owe Anna an additional top off in June to account for the additional shortfall that they've calculated. Same thing with Beth. We again account for the fact that she's not only enrolled in medical, but she's also enrolled in dental. Her top off payment should increase, but she's a part-time employee, so it's based off of the hours she worked last year. Her top off payment will increase, but not by too much. And then we have Carlos, who initially did not get any top off payment when the numbers were calculated in February, But with this refund, they're realizing that their medical plan fell short, so they now owe Carlos a top off as well. So they'll make this additional round of top off payments once they've gotten the information about how much of a refund they're getting. And just so you note, for reporting purposes, the top off payments are not considered part of the value of the plan. So if you have calculated that your plan is worth $3.24 an hour and you make an additional top off payment to get to the 385, your plan is still valued at 324 an hour. So you complied by making the additional top off payments, but that doesn't mean that your plan met the spending requirements. It's only the combination of the hourly spend plus the top offs that got you to that dollar amount, but the plan itself is still only worth 324. And then just a note here, this does cause confusion a lot about remote work. So a covered employee under the HCSO is someone who is physically working in San Francisco. So if you have someone who works from home and they live in San Francisco, they're covered. If you have someone who works from home and does not live in San Francisco, they're not covered. Or if, we're seeing this increasingly more frequently, but if you have an employee who's got a hybrid arrangement, so I come to the office in San Francisco 2 days a week and I work at home in Oakland 3 days a week, you only need to account for their hours in San Francisco. So when you're looking at that top off amount, you don't need to count the non-San Francisco hours if you have someone who's in a hybrid situation. And then other requirements that we just need to remind you of that apply are the annual reporting form that's due every April. That is how you show OLSE the different ways that you complied with the HCSO in 2025. Record keeping is important. There's several records that all employers are required to maintain, but specifically for self-funded employers, you want to make sure that you have records of your calculations and the underlying data that you used to perform those calculations. A lot of employers don't actually do the calculations themselves. They probably have their broker do it. So they're going to want to keep whatever their broker sent them and have somebody available to answer their questions if they don't understand how the calculations were made. Payroll records is something that you would be using to calculate the top off payments because it's going to show people's start and end dates and the hours worked. Anything that you give to employees to communicate about the top off payments, you want to keep records of those. This is in the event of an audit, but also in the event that, for example, an employee has a question about how their top off payment was calculated, or if our office calls and has some questions for you, you just want to be able to go back to your records and so that you can point to the records you have to answer our questions. And we are going to go to some best practices after this, but I will see if there are any more questions right now. Bianca, did you see anything come in?
Yeah, we have a couple. One of the questions is about what qualifies as a healthcare expenditure, and this is about employee assistance programs that offer counseling, mindfulness apps to employees. Can those be included as healthcare expenditures? And what about wellness programs?
Okay, good question. EAPs, you can only include expenditures to the extent you can actually break it down into what is healthcare versus not. So if you are able to, most EAPs offer different types of services. So for example, if you have an EAP where someone is getting 6 therapy sessions a year, that would count as a healthcare expenditure, but often those programs mix everything together. So it's usually a flat dollar amount, and the employee has access to other things like legal services or financial services, financial counseling. A lot of those, they're usually lumped in together. So you could only count it if you were able to separate out specifically what was not only healthcare expenditure, but an irrevocable healthcare expenditure. So it can be a little tricky to separate those out. I can tell you the EAP that we have through the city would not count as a healthcare expenditure. What was the second part of that question, Bianca?
What about wellness programs?
Oh yeah, same thing with wellness programs. So that is very vague. If I would suggest you call our office and describe that a little bit more. So those can be structured differently and they can cover different items. So if it's a wellness program that results in actual healthcare to the employee, it may count. But again, that's kind of a broad umbrella of different services, and we wouldn't really be able to answer that without knowing more about what specifically that program is.
Thanks, Maura. And then on related to the general topic of what is a healthcare expenditure and what can employers take credit for, do HRA and or health FSA contributions made by employers count?
Good question. So health reimbursement arrangement contributions can count if they are irrevocable, meaning the employer puts money into the HRA program and does not get it back. So if it's a use it or lose it type of situation for the employee, that's not irrevocable. So there are irrevocable HRAs and those can count, but I just want to caution you that there are many HRAs out there that do not comply because either the funds expire or the employer is able to get a refund for money that's not used, or sometimes the employer has simply allocated it but not spent it. So none of those scenarios would comply because they would not be irrevocable expenditures. FSAs tend to be like EAPs where they cover a wide variety of things. And usually FSAs, well, they can be structured in different ways, but most of the time an FSA is actually the employee's own money, not the employer's expenditure. And they often usually need to be used within a certain amount of time or they expire. So those would not comply either.
Thanks, Maura. I'm going to pitch one more question to you. I know we're right at 60 minutes. Do you average the hours for full-time or part-time employees, or do you have to do individual calculations for each employee?
Good question. So when you're looking at the healthcare cost, so if you're looking at the cost of the health plan, you can use, you can average together all of the employees' costs with all of the employees' hours. However, when you're looking at making the top-off payments, you want to look at the specific employee's hours because a part-time employee is going to be entitled to a smaller top-off than a full-time employee. So the answer is yes, you average them when you're averaging your expenditures and coming up with the hourly rate, but then when you're making your top-offs, you're looking at the individual's hours. But yeah, you're right, Bianca. I do want to make sure we have time for best practices. So we will, continue to take questions during the webinar and afterwards, and we will get them answered. If we don't before the end of this webinar, we will address them by the end of close of business on Friday. So I do want to cover a few things that we've observed over the years through many, many calls that we get on our hotline from employees and from employers. The number one thing that we can recommend to employers is to communicate with your employees and to be transparent. Most employees have no idea how much their health plan costs, and most employees don't even know that the plan that they're enrolled in is self-funded. And they also don't know the consequences of having a self-funded health plan. So what we recommend is strong communication um, specifically during open enrollment or when you have a new hire. If someone's enrolled in a self-funded plan, you want to communicate that to them. Let them know that that means that they only get an annual top off, not a quarterly top off. Um, if you're making top off payments, you want to let them know when that's going to happen, how it's going to happen. Is it going to be made to the city option program or in some other way? Our website does have a sample letter you can use to send out to employees regarding top offs. Um, and also, if you're going to have any sort of significant transitions in your benefits, you want to be very transparent and clear to employees about what they can expect. So, for example, if you're switching from a fully funded health plan to a self-funded health plan, that might mean that employees who historically got quarterly city option payments are now going to get them annually. They're not necessarily going to understand why, and so it's important for you to explain that to them. I can tell you, well, Bianca and I can tell you that probably the most common hotline call we get from employees is listed right here. Why does my coworker get something that I don't? Um, and the answer is because people have different health plans. An employer might be offering a self-funded plan, a fully funded plan. Some employees might be waiving the insurance and getting quarterly city option payments. And so a lot of times employees are calling our office or calling OLSE because they can't get their questions answered by their employer. Um, and so it's really important to have a knowledgeable point person who's familiar with the HCSO and can explain to somebody, hey, well, you might have a colleague who's getting $1,800 every quarter into their SFMRA, but you're not getting that because you're enrolled in a fully funded health plan and we're spending $800 a month on that. So you're not entitled to something. You're not entitled to an additional expenditure. Or maybe you're enrolled in a self-funded health plan, so at the end of the calendar year, we're going to be reviewing the costs of that. And if we fell short, then we'll make a top-off payment for you. Um, if employees can't get these questions answered, they will call us. And if we cannot get questions answered by an employer in a timely manner, or we can't locate a knowledgeable point person, the employer is more at risk of having an audit. Um, a lot of large employers kind of outsource their benefits, HR and benefits inquiries to some sort of hotline or central service. And we hear frequently from employees that, hey, I called the benefits hotline. They didn't know anything about the San Francisco law. They didn't know anything about quarterly payments. They didn't know anything about an annual top off. They couldn't tell me what I'm entitled to and what I'm enrolled in and how that impacts it. So, communicating with the employees, but also having someone that they can go to who can answer their questions is going to help everybody. And then the third thing we've noticed is employers can be proactive, and there are different ways you can kind of prevent surprises at the end of the year. So, for example, if you did have um, a really large shortfall last year, you might want to look at your health plan and see if you could make any changes. For example, if you reduce the employee share of cost, you're probably going to have more people enroll and your expenditures are going to go up, and you might have a smaller shortfall next year. Um, you can also choose, it's not required, but a lot of employers choose to make top-off payments throughout the year so that they can avoid a large top-off payment all at once. So an example of that would be if an employer um, has a self-funded dental plan, they know it's not going to meet the expenditure requirements because it's only dental. They might look at those employees that are enrolled only in dental, and they might decide to stretch out those top-off payments to that group throughout the year instead of having a huge lump sum in February. And then um, again, this first one up here is about transparency and communication. So if you have employees who are switching from fully funded to self-funded health plans, that's going to impact their quarterly top-off payments. So if they suddenly stop getting quarterly payments, they probably are not going to know that it's because the plan they enrolled in has changed or became self-funded, or that they switched from a fully funded to a self-funded health plan. So communicating with that group is really important, because anytime someone stops getting something they were used to getting, that's when we get the calls. And speaking of calls, we have got a hotline available. Again, as Bianca mentioned, we are here to be a resource, so you do not get penalized for calling to ask for help. Um, we have processes in place where we can guide employers through remedying any past or current compliance problems. It's much better for you to contact us than for us to be contacting you after a violation has been discovered. So please go ahead, and when these slides are posted on our website, these are going to be live links so that you can sign up for our updates. As Bianca mentioned, we have a very active Board of Supervisors here in San Francisco, so there are frequently new labor laws passed. We inform employers about that through our email list, so please sign up for that. And then our website has got just general HCSO information, but we are also, by the end of today, going to be posting the slides from this webinar, as well as some PDFs that have instructions and calculation examples, as well as sample letters that you can use to communicate with your employees about the annual top-offs. And again, thank you for attending today, and we will respond to any sort of follow-up questions. And if something occurs to you later today, please go ahead and shoot us an email or give us a call. Thank you.
Thank you.